Okay, looks like we still have a few people joining us on our call, so we'll give it another 30 seconds or so, and then we'll start in just a moment. Okay, got some additional people dialing in, but in the interest of time, why don't we go ahead and get started? We will be recording this webinar today, and we'll make a replay available after the webinar, and we'll send it to everybody that's signed up and get that out over the next day or two. Let me first start by way of introduction. And for those that I haven't had the opportunity to meet yet, my name is Chris Reese. I am the founder and CEO of MJ REIT. Personally, I've been in the institutional asset management space for almost 30 years, half of those on the public side. And then I transitioned to private markets about 14 years ago. And for me, the reason for the transition from public to private was in the tech crash of 2000. I was at Vanguard, and we thought we built some diversified portfolios for our investors on public equities and public bonds. But when you had a global crisis, the correlations went to one, and diversification that we thought we had went out the window. So I looked at private markets as an area that could enhance the return for investors, provide additional stability, and then ultimately lower the volatility. And I started in the private markets 14 years ago and launched MJ REIT in the summer of 2022. And today's presentation really is going to be focused on education in the first component, first part of the presentation. And then we'll dive a little bit deeper into the portfolio. And my goal is really to provide an update as well as a detailed walkthrough of the portfolio, our holdings, and the opportunity that we see in the real estate market within cannabis. So with that, let's start today's presentation. And before I begin, just a quick disclaimer. This presentation is not intended to either buy or sell securities. That is made only through the PPM. Consult a financial advisor before investing. And of course, past performance is not a guarantee of future results. So who are we? We are an institutional real estate lender managing a debt fund, essentially providing capital to a capital-starved industry. And this is an important component because when we lend into the cannabis real estate sector, because of that scarcity of capital, we're able to charge more for the money we're deploying, which in turn allows us to generate better risk-adjusted returns for investors. We are focused on risk, and the fund itself pays monthly distributions. We have monthly purchases, monthly redemptions, 1099 tax reporting, which we will be sending our 1099s out over the next few days to all of our investors. And importantly, transparency in the valuation of the portfolio. When we launched, launched at $25 per share. Today, we're trading at our value at $25.05. So we've provided stability for our investors along the way and currently priced at $25.05, as I mentioned. We do target a double-digit annualized monthly distribution. We're going to talk a little bit more about that as we go through today's presentation. And I'm very proud of the return that we've been able to generate for our investors. So since inception, our annualized return net of fees and expenses stand at 11.07%. And importantly, and I'll say this several times today, that we don't touch the plant. And what I mean by that is that we're not lending directly to an operator, but rather we're simply financing a piece of commercial real estate on either the industrial or retail side. So we're not lending directly to an operator, which means we're at arm's length and we actually don't touch the plant itself. Today's presentation, I broke up into four separate segments. The first is, and some of this may be a little bit basic for some of you, but I want to level set across the board. The first one is, why should one consider alternative investments to begin with? Then we'll transition and look at private real estate. And then we'll specifically spend some time on what I'll call thematic or specialty real estate. And that would involve lending on properties within the broader cannabis ecosystem. And then we'll end with a segment on how MJ REIT may be a fit for your portfolio. Now, when I talk to investors, I usually like to level set and talk a little bit about the companies in the United States overall. If you looked at both public and private companies and looked at the companies that have 100 million or more in annualized revenue, you'd find that 14% of those are public and 86% are private. So if you had exposure only to public equities and public bonds, you're essentially missing 86% of the opportunity. So we believe, and when I transitioned to the private market years ago, really I saw these types of numbers and selfishly for my own personal portfolio knew that I wanted to have exposure, but it was very difficult to get that exposure. And then in addition to that, even if you looked at what I'll loosely define as mega cap companies with $1 billion or more in annual revenue, you'll find a similar story in that out of the 18% of companies out there with $1 billion or more of revenue, 11% of those are private, with 7% being public. So even on the large scale, having exposure to private companies certainly makes sense, we believe, for all investors' portfolios. And we believe it makes sense because alternative investments into private markets can enhance one's portfolio diversification. So it'll lower that correlation. It also has the ability to dampen volatility. And the reason it dampens the volatility is our fund, for example, is not priced daily or intraday. We're priced once a month. So we don't see the wild swings in investor sentiment that you see in the public market. So by going private, it can lower a portfolio's volatility. And lastly, private markets and alternative investments have the ability to enhance one's portfolio return. So really, for us, it makes sense to at least consider a portion of your assets to be dedicated to private markets within alternative investments. And if we looked at how the ultra wealthy invest, and I stole this slide from Tiger 21. For those that don't know, Tiger 21 is a membership only society, I'll call them, where you have to have a liquid net worth of at least $25 million. And every quarter, they poll their members to see how they're allocated. And the takeaway for me, if you look at both the public markets by the stock market as well as fixed income or bonds, you'd have a combined 29% of that exposure is in public markets. 60% is divided over a few different private or alternative investments, and they would include real estate, private equity, hedge funds, commodities, and even crypto or just currencies. And so 60% of their allocation is dedicated to alternative investments. And while we're not advocating that everybody on the phone today allocate 60% of their assets to private markets, the takeaway for me is that if you look at how the ultra wealthy invest, they do have a large exposure to alternative investments. And as such, we believe it makes sense for investors to consider an allocation to this area of the market. So real estate overall, if you looked at the real estate market and compared it to fixed income or bonds, as well as stocks, you'd see that that real estate is the third largest asset class in the United States, behind bonds, which total about $54 trillion, and equities, which are just under $50 trillion. So real estate comprises about $24 trillion on the commercial side of value. But unlike bonds or unlike stocks, you get the best of both worlds within the real estate market, because not only can you earn income from rents, but you can also get the appreciation from the property value. So for us, it's really real estate providing the income orientation that you would typically get in bonds, as well as the growth oriented side that you would typically get in stocks. And so it's an income and growth oriented strategy, and it's a very large market. And similar to the private area that we looked at earlier in the presentation, private markets are still the primary way that investors get into commercial real estate. If you looked at all of the opportunity in the marketplace through the public REITs, that accounts for about 6% of the market. 94% of that market is private. And similar to how the ultra wealthy had exposure to real estate, if you look at the public pensions and endowments, which are shown on the right-hand side of the screen, public pensions having about 12% of their allocation dedicated to commercial real estate, and endowments at about 10%. But if you look on the far right, the average individual investor has less than 3% of his or her portfolio dedicated to this area of the market. We believe that number should be higher because it does provide additional diversification and the potential to enhance returns. Real estate has historically been a good diversifier of one's investments because it has the ability to outpace inflation. So what I show in the chart here is I show the operating income versus inflation shown by the US CPI, which is a little bit dated. This chart goes through the end of 23, but if you roll it forward, you would see a similar outperformance, or that inflation is not keeping up with the overall operating income. And the reason for that is that rents typically increase faster than that of inflation. So an investment in real estate can serve as a hedge against inflation. And then in addition to the hedge against inflation, private real estate has historically been consistent with its annualized distribution. So I looked over the last 20 years, and I've charted on this particular page the annualized distribution on different years. And what's notable for me is that if you look at those years with 4% or greater, you get 16 years that the private real estate market has distributed at least 4% in annual income. 4 of those years between 3 and 4, and 0 of those years less than 3% annualized. Now, 6% is nothing to get too excited about. And often in the specialty real estate area, we can generate significantly higher levels of income, which we'll talk about in just a moment, where we could generate or put money to work in the market anywhere between 12 and 14%. And so that's the area of the market that we tend to focus on. And because of that, we're able to generate additional returns above and beyond these. But the point here is that the consistency that we've seen in the real estate market is certainly prevails. So when we talk about specialty real estate, I want to define a couple of areas overall before we get into the weeds. And you can think of specialty real estate as really that real estate that doesn't stand out or that you don't hear about every day. We hear about offices, we hear about different types of industrial buildings, but if you look at some of the smaller pockets within the real estate market, like for example, movie theaters or luxury homes, agricultural, medical buildings, even parking garages, cannabis also fits neatly within this idea of specialty real estate because it's not encompassing the traditional areas that one most likely has exposure to. And because of that, cannabis can diversify one's real estate holdings as well as enhance the diversification within a broader portfolio. And when we looked at cannabis real estate to begin or start this particular strategy, really there were 3 characteristics that led me to launching MJ REIT to fund this area of the scarce capital within the market. And then that is that cannabis has strong growth potential and characteristics. And cannabis continues to be one of the fastest growing areas within the US economy. And it's doing so without the traditional access to banks. So you can't, I'll put it this way, if you have a cannabis dispensary, you can't go to Wells Fargo and obtain a mortgage because cannabis is still a Schedule I narcotic controlled substance. Banks just simply aren't lending into the space. And then lastly, you have limited institutional involvement. And this institutional involvement will change over time as the ice begins to melt and more institutions come into the market. And when that happens, you'll see a flood of capital come in and essentially elevate asset prices. And so you have cannabis showing high growth potential, a lack of traditional financing, and limited institutional involvement. And when you put these 3 together, you can generally earn a better risk-adjusted return for investors. And that's exactly what we've done with MJ REIT. I like this slide because it tends to sum up the movement within the cannabis market over the years. The first movement on cannabis to legalize was in 1996 with Proposition 215 in the state of California, which essentially legalized medical marijuana. If you roll forward 4 years, and you'll see the chart on the left-hand side, the map of the US, all of the West Coast had a legalized medical program. And then if you roll forward 10 years, which is in the middle of the screen, you'll see more and more states continue to legalize, and even some states on the eastern seaboard. And then if you look at the map on the right-hand side, in 2025, you'll see that almost the entire country has at least a medical program, with many of those states offering what we'll loosely define as recreational or adult use programs. So in the United States today, there are 41 states, DC, and a few US territories that have access to at least medical marijuana. And what's interesting is that because cannabis is still a Schedule One controlled substance, there's no interstate movement of cannabis, meaning that if the state of California has a program, it needs to grow, process, and sell that cannabis in that particular state. That creates a barrier to entry for us and what we do in the fund, creating the opportunity for us to deal in these unique markets without the fear of Philip Morris coming in and buying 200,000 acres in New Mexico and then growing cannabis and shipping it across the country, which that will happen over time as the market matures and as ultimately cannabis becomes legal. But for the foreseeable future, we believe that we're in an opportunity zone where we can go out and deploy our capital at attractive rates and generate better risk-adjusted returns for our investors. From a total sales standpoint, I like this slide because it shows you the overall impact that cannabis has on the U.S. economy. So in 2025, cannabis sales are expected to come in close to $35 billion. Might be a little bit lower than that, but above $30 billion. And it's a large market. If you look at the additional economic impact in 2025, which is estimated to be about $88 billion, with a total of $123 billion in total economic impact. And that economic impact takes into consideration, let's say you work at a dispensary, you get a paycheck, you spend that paycheck on car insurance, rent, you spend it on groceries, and that's where the additional economic impact comes into play. The actual retail sales, which I mentioned at about $35 billion, that's in the legal market. If you were to look at the illicit or illegal market, it's estimated that is another $70 to $80 billion. So if you put those two together, you'll have a market that has total sales in excess of $100 billion, which rivals that of tobacco or even spirits or alcohol in the United States. So point being is that it is a very large market. It's growing. More and more states are coming online. And as those states come online, that creates additional demand for the real estate. And that's exactly the sandbox in which we play. The idea that banking is really not prevalent in the cannabis industry is shown on the left-hand side of this slide. If you looked at the number of banks in the United States, it's a little less than 4,500 banks. Everybody on the line, if we were operating a dispensary, we have about 830 of those banks that would actually accept our deposit, but less than 50, and the number is actually closer to 25, out there would actually make us a loan. And so banks really are not in this area of the market yet. And as cannabis becomes more and more legal, it gets rescheduled or there's a Safe Banking Act that actually passes. I do anticipate more of the small community and regional banks, but I think your large money wire banks simply aren't going to participate. And the reason for that is they have, let's say you're JP Morgan and you have a $5 billion mandate with the government of Singapore. Would you jeopardize getting into a cannabis market to bank a couple $100 million and potentially lose your $5 billion mandate? Probably not. And so I think while some of the smaller banks will eventually get into the space, which we don't believe that will happen for at least 5 to 7 years, the larger banks would most likely not get into this space for the foreseeable future. And then I mentioned institutional ownership. On the right-hand side, I show a slide, or a chart, I should say, that compares the top 5 alcohol and tobacco stocks versus the top 5 cannabis MSOs, which stands for multi-state operator. You'll see that the top 5 tobacco and alcohol stocks, they have almost 78% institutional ownership. But if you look at the top 5 cannabis MSOs, that institutional ownership is less than 10%. So as cannabis becomes more, I'll say, legalized or moves from a Schedule 1 to a Schedule 3, and then ultimately potentially being deschedulized, we would expect to see more and more institutional money flow into the market. So how do we capture this opportunity? We're going to talk a little bit more for the remainder of today's presentation, specifically about MJ REIT. So our investment statement is there, and investor value proposition. From a high level, and I won't read both of these sections, but from a high level, we simply originate debt and equity transactions to finance cannabis companies. And we do that specifically on the real estate side and not the company side. So I want to be very specific there. Again, we're not lending to an operator. We're simply financing a piece of commercial real estate. So for us, we put together MJ REIT, which allows us and will primarily traffic on the private side of the real estate market. But we do have a small section of the portfolio that if we did see a dislocation on the public side, we could certainly allocate to try to pick up some additional return. Right now, we're 100% invested in the private area of the real estate market. The goal of MJ REIT is to provide price stability. And I mentioned we launched at $25 a share. Today, we're at $25.05. And we're also focused on providing investors an above market monthly distribution. On the screen, I show on the right-hand side the monthly annualized distribution since we launched back in September of 2022. It's essentially ranged from about 10.2% on the low side to 16.67% on the high side. And I'm proud to say that we've exceeded our 10% annualized distribution target every month since inception. So December finalized 40 months of performance. And I would like to point out, if you look at those 3 months, one in March of 24, one of May of 24, and in October of 2024, we ended up selling a property in each one of those months where we had a profits interest, which we earned additional income. And because we're taxed as a REIT, we've essentially pushed that income onto our investors. And each of those 3 months had a distribution annualized greater than 15%. I will note that we do have a fourth property that is scheduled to close in February, so next month. When that does occur, I would anticipate another 15+% annualized distribution for our investors. Additionally, because we're taxed as a REIT, there is a tax benefit for all of our investors. And this is not specific to MJ REIT, it's specific to all REITs in the market. And that is you're only paying tax on 80% of the distribution on the federal level. So on the left-hand side, I show a hypothetical distribution of 10%. You'd have to find a taxable yield of about 11.2% to equal what you're getting inside of MJ REIT. So we do have a little bit of additional benefit through the tax deduction aspect. If you would have put $100,000 into the fund day one, it's grown nicely to where it is today, just below $142,000. That nets out to be an 11.07% annualized return. The latest distribution in the month of December, we paid a 10.75% annualized distribution. And importantly, 100% of the distributions that we paid over the years, that is entirely from interest or rent that we earn off of our investment. We are not redistributing capital or over distributing, returning capital to inflate the distributions that you see, but rather it's solely from the interest that we've earned or rents that we've taken in. And this is one of the most important slides in the presentation because in every deal we get into, we assume that cannabis goes away and we need to re-tenant that property with a non-cannabis tenant. And generally how it works in the cannabis market is, let's say everybody on the line, we get together and we apply to the state of California for a license to cultivate cannabis. So we get that license, we identify an industrial property, we buy that property for $2 million. It's not out of the question that we may need to put $6 million of improvements into that building to get it operational to grow cannabis. That could be HVAC, high-tech security, lighting, irrigation. And so that $6 million that we put in added to the $2 million. And now for all of us, we think that property has a value of $8 million. And to a cannabis grower, that valuation is probably right around that $8 million. But if you're a non-cannabis tenant, you don't need access to 15 air conditioners and state-of-the-art security, and nor are you going to pay for them. And so at the fund level, we would come into this particular deal and say, if we need to kick this cannabis tenant out, what could we value this building or sell this property for? And that would be really the $2 million, the original valuation or purchase price in this particular example. And so we would come in, value this at say 2 or maybe 2.25 million, and then underwrite or originate a short-term senior mortgage at 75% LTV. So think about the risk and the downside protection that we have in this particular example. We have a property with a cannabis valuation of $8 million, a non-cannabis valuation of $2 million, and we have a senior mortgage at roughly 1.5 million. So there is ample downside protection. So even if we needed to come in and re-tenant this particular property, we feel confident that we would be able to re-tenant this particular property at the lower valuation and be able to secure and keep our $1.5 million investment stable. And so unlike a lot of the other firms in the marketplace that were in this particular space, we're one of the few firms that use the non-cannabis valuation to protect our investors and ultimately dampen the downside risk in the portfolio. Since we launched, these are all of the cities and properties that we are in. Since launch, we've financed 35 properties across 11 states. 3 of those, which are the ones highlighted in blue and highlighted at the bottom of the page, have paid off, with a 4th that is set to close in February. The ones that paid off have generated anywhere between a 31.5% to a 65% IRR for our investors. And of course, because once again, we're taxed as a REIT, we will distribute that above market income once that property does close in the month of February. So I do anticipate a very attractive distribution coming up next month. I wanted to just highlight 2 of the most recent deals. These are both industrial examples, but we do have, as you'll see on the next page, some exposure to retail or dispensaries. We did 2 transactions in the month of December. The one on the left-hand side was in Minneapolis. The property itself is located about 10 miles from downtown. The tenant is a company called Grown Rogue. They're a publicly traded, vertically integrated MSO. They do have operations in Oregon, Michigan, as well as New Jersey. Minnesota is a market that launched in October of 2025. So it's a newer market. So recreational or adult use sales just began. And if you look at the sales so far since Minneapolis or since Minnesota launched, you're at about $35 million so far in that particular state. This building was purchased for just under $8 million. It is a sale leaseback transaction. It has a 5-year triple net lease with 3% annual rent increases. And in addition to the purchase of the building, we also underwrote a $2.75 million senior mortgage, our loan, at roughly 14.5%. So you can see on a transaction like this, not only are we collecting an attractive rent, but we also underwrote that loan where we're getting a 14.5% yield on our money, which allows us ultimately to pay that 10+% distribution to our investors consistently. And then on the right-hand side, just a quick example of the last deal we closed in 2025, also an industrial property, this one located in Grand Rapids, Michigan. This is a senior mortgage, roughly $11.5 million with a loan to value on a non-cannabis basis of 71%. And this one, similar to the loan on the sale leaseback, is at 14.5%, along with personal and corporate guarantees. And so deals like this, where you have high caliber tenants like Grown Rogue in Minnesota, like Flourish in Michigan, these tenants have demonstrated over time their ability to not only execute on a business plan, but also continue to grow in sometimes challenging markets. I will say in the Grand Rapids deal, the sponsor has actually invested $51 million into this particular property. And that kind of goes back to this idea of buying the property for $2 million and putting $6 million into it. So this is a real life example where the sponsor has deployed a significant amount of capital into this building. So if they didn't meet that senior mortgage, we certainly could step in and sell this property for at least $11.5 million, if not something significantly higher. And then from a diversification standpoint, we will tend to focus and have the majority of the portfolio allocated to senior mortgages. We're currently, as of 12/31, as of the end of last year, we have just under 87% of the portfolio in senior debt. We have 12% in sale leaseback transactions, and we're sitting on about 1% in cash. From a sector diversification standpoint, we have just about 71% of the portfolio dedicated to industrial. We have about 25.5 to retail, and those are the dispensaries. And I show office here. It's not necessarily an investment in an office. One of the deals that we underwrote, the deal itself covers an office building, a small office building that the borrower occupies for their own business purposes. Small exposure office, but you'll see industrial and retail always dominating the majority of the portfolio. And then from a geographic standpoint, we're now in 11 states across the board. We do have a 12th one that we are currently underwriting. Stay tuned on that, but I anticipate by the end of the year, we could have anywhere between 12 to 15 states in the portfolio overall. I want to spend a moment, and this is an important distinction of our sub-manager. And the sub-manager, Rainbow Realty Group, is responsible for diligencing all the properties, and they're the ones out doing site visits and underwriting and originating those deals. Rainbow Realty Group is a part of Gould Investors, and Gould Investors, for their part, they're about a $3 billion private real estate family. They do manage 2 publicly traded non-cannabis REITs, which you'll see highlighted on the left-hand side, trading on the New York Stock Exchange under BRT and OLP. And Rainbow and Gould overall have a fully built out back office with over 70 people that we rely on for not only accounting, legal, property management, and a number of other activities. And Rainbow Realty Group also manages, you'll see on the right-hand side, 4 institutional funds by which MJ REIT is run pari passu. And what that allows us to do is if there's a $10 million deal, we may only have $1 million in liquidity or $2 million of liquidity to put into that deal. So MJ REIT would put their allocation in, and then the institutional funds would fill the remainder of that allocation. So let's say we put $1 million in of a $10 million deal. They would call in $9 million of institutional capital to complete that transaction. And so we can share in deals amongst the institutional funds at the same rates. There's no change or discount that we earn. All of the funds are run pari passu with the deals in each. From an investment team standpoint, I'm very proud of the team at Rainbow, where collectively the 7 investment committee members have over 200 years of real estate experience doing structure, accounting, legal, all of that focus within the broader thematic real estate market. So no deal gets into the portfolio unless it gets approved by this 7-member investment committee. And speaking of deals, because of the scarcity of capital versus the demand for capital in the cannabis real estate market, we can be very selective on the deals that we fund. So for every 100 deals that we look at, we're generally going to fund only a few of those deals, call it 2 to 3 of those particular deals. So we can be very selective in those particular transactions. And if you looked at 2025, we analyzed over $300 million in deals, but only funded about $58 million in total. Our current pipeline exceeds $75 million in transactions spread across the country, and we will traffic in any one of those 41 state legal jurisdictions. And so we'll talk to anybody that's looking to borrow, but we'll again be very, very selective in those deals that we are going to fund. And how we exit deals, the first 2 circles are predominantly the main way, but we do have 4 potential ways to exit deals. First is that the property is sold, and with that sale, no different than a standard mortgage, we get paid off. The second way that we exit a deal is, let's say, after a couple years of operation, you find another lender in the market and you refinance us out and potentially at a lower rate, and we get our money back, and then we redeploy that into the market. The third way, which is generally a little less likely, is that the borrower generates enough free cash flow simply to pay off the loan at maturity. Or the fourth way is that they raise equity capital, and part of that transaction, the debt is paid off in full from the equity investment. And so those are the 4 ways, with the primary way being the borrower selling the property or refinancing us out. And as I mentioned, we do have another property that is set to close in the month of February. And so we would essentially get that capital back and then reallocate that capital to a new deal in the marketplace. From a staff standpoint, these are the faces of the individuals that work full-time, dedicated to ensuring your investment dollars are allocated judiciously. Myself, the CEO and founder of MJ REIT, my partner, Gopa Dobson, is the Chief Revenue Officer at MJ REIT. And then three of our team member over at Rainbow Realty Group, Kyle Schenfeld, he's the CEO, Matt Gould as the Chief Investment Officer, and Ben Bolanos as the Chief Operating Officer. You can see from our background, dedicated years of experience, everybody has a significant amount of focus and dedication to ensuring that every deal that we put into the portfolio meets a very conservative underwriting and ultimately is generating a significant amount of distribution for our investors. So what makes us unique? And by this time, I suspect this probably is not news. It's a recap of what we just talked about. We focus, I'll say it this way, we are an institutional real estate lender, and we focus exclusively on real estate within the cannabis markets. Cannabis markets are unique because every state that has a program has its own set of rules and regulations. So there's no widespread cannabis legal on the federal level, and there's one set of rules and regulations. That's not the case. So you need to be in this market, and you really have to have a solid understanding to effectively traffic in this area of the economy. And we've done this before with 30 in the portfolio today, 32 properties across 11 states. And as I mentioned, every one of those properties or investments was vetted by the 7-member investment committee. And to date, I'm very proud of this, that we've had 0 defaults in an otherwise fairly volatile credit market. So I'm very proud that we've managed to steer clear of defaults, and we dislike downside. And this gets to the point that we stress test every deal that we put into the portfolio, with the biggest risk mitigation being the non-cannabis valuation that we employ in every one of the transactions that we underwrite. And so why would one consider allocating to MJ REIT? First and foremost, most of our investors do it for the consistent double-digit annualized monthly income. They also look to diversify their investment portfolio and potentially even escape some of the market volatility that you see on the public side. And then the added benefit is the additional tax benefit from the distributions and not paying tax on the full distribution at the federal level. So those really are the 4 ways, with the consistent double-digit income being the primary driver. We do have an independent board of directors. I show the faces here. Myself as chairman and CEO of MJ REIT, Matt Gould, who's my partner and board member at Rainbow Realty Group. Michelle Gillespie is an independent board member, as well as Matt Malone and Jeff Mylock. All of these individuals with significant experience, and I'm very, very privileged to work alongside such dedicated individuals. And just a quick summary on why we believe now is the time to allocate to MJ REIT. First and foremost, we are an institutional real estate manager. So we're bringing that institutional management style to this area of the market. This is a timely opportunity. It's an opportunity that won't be around forever. We look at it as an opportunity for the next 5 to 7 years. And because we offer that monthly liquidity program, this allows you to create your own maturity. So you come into the portfolio, and let's say you hold us or allocate to us for 2 years, and then you have a better investment that comes along. You simply tender your shares, we give you the capital back, and then you allocate to a different investment opportunity. So we allow you as the investor to determine how long to hold the fund, and you're not beholden to us to generate a liquidity event in 5 to 7 years. And hopefully that liquidity event is at a price better than what you paid. Ours allows for that monthly withdrawals. No capital calls inside of the portfolio. It is a 1099, as I mentioned, a dividend tax paying or for the tax reporting. We don't have a lengthy lockup, and our minimum investment is only $25,000. If you look at the portfolio overall, we believe that it's an opportunity to help investors by allocating to the portfolio, really to help dampen that volatility and enhance your monthly distribution. And that's really the reason why most of our investors get into the portfolio. At this point, let me pause for just a second. If there are any questions, you can hit the Q&A button and submit those questions. And I'll pause for a second. We do have a couple of questions that have come in, but if you have an additional one or I didn't answer that question along the way, I'm certainly happy to take that now. Looks like the first question from John is, do we allow for the distributions to be reinvested? Good question, John. We do have a dividend reinvestment program. About 74% of our investors actually participate in the dividend reinvestment program. And by the way, you can change this back and forth when you see fit. The dividend reinvestment program is unique because if you do participate and you reinvest that distribution into additional shares, you do so at a 1% discount. And so you're buying those shares at 99% of NAV or net asset value versus at 100%. And so that gives you essentially a boost in your overall total return. So thank you for that question. Another question is, given the, I guess we're talking about the change or the potential change in cannabis at the federal level based on the news that Trump announced last month, will that have an impact, and what are our thoughts on cannabis being legal at the federal level? So a lot in that one. First and foremost, I would say that with President Trump's news last month of pushing cannabis to be rescheduled from a Schedule 1 to a Schedule 3 controlled substance is not something that he alone can actually affect. That would need to be done by the Department of Justice along with the DEA, who essentially has oversight on which substance is a Schedule 1 through a Schedule 5. Cannabis today at a Schedule 1 narcotic is alongside substances like LSD, where the DEA deems there's to be a high addiction rate and no medical benefit. Now, we know that on the medical side, there's proven medical benefits to cannabis. And ultimately, what are the most likely scenario is that we will see cannabis over the course of maybe in 2026, or maybe that will get into 2027, where cannabis will be rescheduled from a Schedule 1 to a Schedule 3 narcotic. The big benefit with that is, and listen, it's hard enough to make it as a small business in the US, but imagine an industry where you couldn't deduct ordinary business expenses. That industry is cannabis because the IRS doesn't allow businesses, if you deal in a Schedule 1 controlled substance, to deduct your business expenses. And so your effective tax rate is north of 70%. So it's very difficult in, again, any small business to make it, but in an industry where you're paying 70% plus in taxes, it's really difficult. So when cannabis gets rescheduled from a Schedule 1 to a Schedule 3, that would allow the businesses to deduct ordinary business expenses. And what that does for, if you think about it, really, it enhances the profitability of our borrowers. They become better credit worthiness borrowers, and that frees up additional cash to meet interest obligations. And so ultimately, we do believe that the rescheduling will occur. Do we think that cannabis will be legal on the federal level? Not for the foreseeable future. Even in President Trump's announcement, he does not support it for recreational use, but merely from a medical standpoint. And so we don't see that cannabis being rescheduled would even come close to making it legal on the federal level. And most likely it would stay illegal for the foreseeable future. And even with the schedule change, it doesn't necessarily allow banks to get into the space. So it really is a great scenario for MJ REIT because it allows our borrowers to have better credit worthiness, but it doesn't allow banks to get into the market. And you'll still see a capital-starved industry, and we should still be able to deploy capital at above market rates and ultimately generate that consistent above market income for our investors. Another question that we have, are there any investors using an IRA to invest? We do have, and thank you for that question, we do have and are on a number of self-directed IRA platforms, and we have a number of investors that have allocated through their retirement savings. If you do have an interest in that, we do work with, as I mentioned, a number of different providers. We can reach out to you and provide some specific details on who we work with. But we do have a number of investors in the portfolio that have allocated their IRA assets to MJ REIT. Okay, I think that finishes the questions. And As I think about it, I look at time as our most valuable asset. And I just wanted to take a moment on behalf of myself, everybody at MJ REIT, and our partners at Rainbow Realty Group to say thank you for taking the time today to join us on our webinar. As a follow-up, here's what you should expect. We'll make an outreach to you either via telephone or email to make sure all of your questions were answered in today's session, and then see if there's any unanswered ones that we can provide a solution or an answer to. And then we'll also make available a replay of this webinar, which will be posted to our our YouTube channel in the next, let's call it 48 hours or so. So we'll email you that link as well when it's ready. So again, thank you everybody for the time today. We appreciate it. We appreciate the consideration, and we look forward to additional conversations. Have a great weekend.